I'll just give you a little introduction in terms of the clients that we look after at Farrers and why we've started this week as our main focus on entrepreneurs. So at Farrers, we act for private businesses, family businesses, investors, and entrepreneurs. Please take a look at our dedicated website for this week, which is entrepreneursweek.co.uk. I've put that into the chat bar. And you can see what we get up to during the course of the year for entrepreneurs and investors. We'd also love it if you could join the conversation this week about it on social media. So you can do so by using the EW2020 hashtag and tagging at Farrer_co on LinkedIn, Twitter, and Instagram. So please do join in. And again, that's in the chat bar. If you haven't already, please do also sign up for the final event of the week, which is tomorrow evening, and that's an hour of cocktails and networking. So a chance to impress us with your own homemade cocktail. And then a couple of housekeeping matters before we get started. Please do keep yourself on mute to prevent any disruption. But the key thing is there's an opportunity here as part of the masterclass to comment or ask questions. And again, please do that through the chat bar, and we can respond to those comments either during the formal part of the session, and also we're hoping to stay online and just extend the session so that there's a chance to sort of chat through the chat bar for a couple of minutes or 15 or so minutes after we've finished. Just to say that the session's being recorded. The reason we're doing that is that we can upload the recording onto our microsite, as well as a couple of key takeaways so that there's a point of reference for the future. We're also here to help after the session, so please do ask questions, follow up with us. Our contact details are on the next slide. If we move across, you'll see us there. In terms of who you've got on the panel this morning, we're very pleased to welcome Matthew Stafford, who's an advisor, mentor, and investor into early stage companies. His bio is on the screen there. He's a co-founder of Dot Matrix Group and 9 others. We're really looking forward to having Matthew's feedback in terms of an investor, as well as welcoming Martin Blake, who's a partner in our banking team. Martin acts for lenders and borrowers, both on traditional funding arrangements, but also more innovative structures. And then there's me. I'm a partner in our corporate team, and I focus on private capital work, by which I mean acting for investors on protecting their capital and investing their capital, as well as for businesses who are obtaining funding, and the founders and management teams behind those businesses when they're looking at ultimately an exit, whether that's partial or a full exit. So if we move on to the next slide, the question is where we are now in terms of fundability of businesses in 2020. First of all, our aim this morning is to keep this session as positive and constructive as we can, despite the current significant health and economic circumstances in which we're in. I also recognise, and we also recognise, that the situation is very fluid, and that we have got the Chancellor making further announcements this afternoon on the extension or further support for businesses. But what we really want to do is make sure you come out of today's session with some further thoughts on the factors that will contribute to your fundability and investability of your business. So as a starting point, what stage is your business at? And these are some of the points that we'll come back to during the session in terms of, is it early stage survival? Is it emergence? Or is it expansion? Because that'll then determine the type of investor and the commercial and legal framework of the funding that you can obtain. Before we get into the detail, I am going to hand over to Martin, who's going to talk about some of the national support that we've got, so that he sets the context of our further conversation.
Thanks, Simon, and hi, everybody. As Simon said, before we start a conversation around raising debt finance more generally, a new feature, as you'll be well aware, on the debt structure landscape generally has arisen over the last 6 months, which is the government lending schemes. And it's worth taking a moment to consider them. I'm going to focus mostly on the Coronavirus Business Interruption Loan Scheme, CBILS, Bounce Back Loan Scheme, BIBBLES, I'm not sure anybody calls it that, but and the Future Fund, which I think are the most relevant schemes for this audience. So firstly, CBILS, as you're probably aware, it's for businesses with a turnover of up to 45 million who can borrow a loan of up to 5 million, interest and fee free for the first 12 months, and 80% of it is government guaranteed. And I'm not going to go through the criteria in any detail, but I do want to draw out one particular one because I'm going to come back to it later on in this session, which is it requires the lender who is administering the particular loan to be satisfied that the business has a viable borrowing proposition. Now, in the context of CBILS, that's been taken to mean broadly, albeit there are different interpretations, 3 years worth of trading records and not be loss-making. Now, as I said, I'm going to come back to this point, but just hold that thought for the time being. In terms of the numbers, under this scheme alone, 13.8 billion has been lent to more than 60,000 businesses. The next loan scheme is the Bounce Back Loan Scheme, which is the loans of up to 50,000, very, very easy online application, self-certification, and there is no requirement under this scheme for a sort of viable proposition. I'm not sure there was any particular criteria at all, as far as I could work out for this scheme. As if you look at the numbers here, 35 billion has been lent there to more than 1.2 million businesses. So a sizable chunk, and I'm mentioning the numbers because I'm going to come to that in a second. And then finally, the Future Fund, which is a convertible loan note offering which matches funding which is raised from other investors, loans of up to 5 million, potentially convertible to equity in due course, and 590 million has been lent there to 590 businesses. Now, as Simon alluded to, we're expecting an announcement later today. These schemes were due to be brought to an end at the end of this month. By all reports, they're going to be extended now till the end of November, with applications due to be sort of processed and concluded by the end of the year. So the third bullet point on this screen talks about sustainability, and I just want to make a quick comment there before handing back to Simon. One way or another, it's predicted that at least 100 billion of government-backed loans will be in the system by early next year. Given what's going on this week, there are questions being raised, which I don't propose to answer, as to how much of that the businesses can afford to repay. But it is a very, very valid point, and we've seen also think tanks across the city and elsewhere come up with different proposals in terms of the repayment or otherwise of these, such as creating a government agency with a power to convert or extend some of this debt, repaying it via means-tested tax obligations, or even creating a government collection agency rather than the banks. None of those proposals have been accepted, unsurprisingly for now. It's a bit premature, but obviously something will need to happen, because that is a lot of debt to be in the system. And when it comes to sort of how it is ultimately dealt with, I'm sort of sure that the government is hoping the banks will deal and vice versa, but that remains to be seen. The point I'm going to sort of make is that there is a lot of debt, and actually, whether it's government backed or not, businesses a lot of businesses have quite a lot of debt already. And when you're thinking about raising further debt, it's a prerequisite that you deal with your existing debt one way or another. And I'm going to talk a little bit more about that in a moment. But back to Simon for the moment.
And I'd like to bring Matthew in here, if I may, really to get some experience in terms of whether you or your investee companies have utilised any of the government funding schemes available.
Yeah, absolutely. Morning, Simon. Hi, everyone. They have. So one of our portfolio companies has made use of has applied to the Future Fund, but only one of them. There have been other companies in our portfolio and that I deal with who've raised investment. But the world I sit in is the early stage startup world, and most of those companies are taking investment from angel investors. I run the DMG syndicate, which is full of angel investors, and they want their EIS kickbacks. And the future fund, unfortunately, isn't compatible with EIS. But one of the companies raised some investment from a trust, which doesn't get EIS at all because of their structure. So they thought, yeah, why not? We'll apply to the future fund. So I think they got up to about 2 million from that, which was great. You're muted, Simon.
Cool. So, as Martin says, that's matched by either existing funders or new funders coming in.
Yes, they had anyone new funders coming in, and then they applied to the future fund, and they got that matched. Yeah.
And I was going to just open that up to those online. If anyone's got experience, please do provide some comments, particularly around the future fund, given that originally they'd set aside, I think it was about 290 million. They're now up to over 500 million in terms of investment. So it does seem to have been successful. But Matthew, as you say, it's more for the more established, later developed businesses that are backed by venture capital / institutional rather than private investors.
Yeah, it was disappointing. When it first came out, we were on a FARA panel at the time, I think, around about when it first came out, and there was a good discussion on it then. And I thought, okay, they put the first draft out, it's going to get redone, and they're going to include EIS, but they didn't, disappointingly. But anyway, it's good that they're giving it out.
Matthew, thank you very much. And if we move on to the next slide, we're going to start on the debt piece and the analysis that Martin's conducted there. Thank you.
Thanks, Simon. So yeah, it's me on debt before we then move on to Simon on equity. So before talking about how a business might raise debt finance, I think it's important to start with the why. And so considering the purpose of raising the debt, is it for cash flow reasons, investment, refinance, acquisition? It's important to be clear on exactly why the business is raising debt and how much is needed and when it's needed. As when presenting to a sort of a potential lender, a clear rationale will add confidence and credibility to the pitch. Then, as I mentioned, I trailed this earlier, existing lending arrangements. To the extent there is existing debt in a business, what are you going to do with it? Is it going to be repaid? Is it going to be extended? Do you need a consent under it? Is it going to be amended? Or is it going to sit alongside the new debt that you're raising? I think it's important at this point to take a step back. If you're looking to add additional debt in, take a step back and look at the bigger picture and see what your debt structure looks like in the round. It's important, I think, to as far as possible, and I appreciate it's not always possible, but to simplify and rationalise the debt that you have wherever possible, not least from minimising hassle and administrative reasons. Next, I've put up there, what is the lender looking for? Now, as we know, not all lenders do this out of the goodness of their own heart. So what is it that they want from this? I think ultimately, I mean, there are many things, but two key ones are they want to know that the business can service and repay the debt. And I talked earlier about a viable borrowing proposition, and I think this is at the heart of it. Forecasts will obviously help, demonstrate affordability, i.e. the ability to service the debt. And those forecasts will need to be credible and based on realistic assumptions. But also if things don't go well, the lender's going to be interested in what assets are available or other sort of recourse in order to be realised in order to repay the debt. So, fourth bullet point, looking then at security and actually guarantees. I'll start with guarantees. So, personal or otherwise, I think before sort of entering into thinking about debt, it's worth considering, is a personal guarantee or otherwise or other sort of guarantee on or off the table, because they can help, but I do appreciate that not everybody wants to head down that path. Looking more in at security, I think if you're looking at the sort of assets that would be available for security, try to think as broadly as possible. So assets can be tangible or intangible. So property, obviously, but also think about investments, intellectual property, revenue streams, stock, book debts, plant and machinery, all sorts. This is where we come to the sort of slightly more innovative side of things. Lenders, the right lender, will consider all sorts of assets as security or other sort of backing for a loan. And it's useful to think more broadly, because I do appreciate, especially some of the businesses that I'm sure are listening in here, they're not going to have big properties that can be used to support a loan. So think sort of broadly and creatively there. And when doing so, I'd offer just two thoughts as to how I think lenders often approach the value of assets as security. Firstly is their actual value, and how stable will that value be over the course of the loan? And then secondly, liquidity. Can the asset in question be sold, and how easily and quickly can it be sold? And if you consider those two things, is the value going to be stable enough, and can you realize it? That will give you an idea as to the usefulness of a particular asset, whether it's tangible or intangible, as security for a loan. So just to recap briefly, we've got the basics, we've got the why, we've looked at the existing lending arrangements, we've considered affordability, we've looked at what assets you can offer by way of security. Now, what is important to you? And I've listed here 4 factors which I think I would think about. Speed, so how quickly can you get the cash, and how quickly do you need to get the cash? Cost, when thinking about cost, it's not just the interest on the loan. Also consider arrangement fees, exit fees, commitment fees, other fees, other costs. For example, legal costs associated with putting a loan in place. The more complex a structure, the more it's going to cost. I mentioned before, when you're looking at existing debt and rationalising arrangements, the simpler the structure, normally the easier it is to implement, and that feeds into cost and ongoing cost. Flexibility. How fixed is the arrangement you're going to enter into, and how fixed do you want it to be? Do you want to be able to exit? Do you want to be able to amend it? How are your borrowing needs, and how will they change over time? It's important to try and think forward on this point. And finally, control. What levels of oversight and consent requirements does a lender want, and what are you willing to give? And if we move to the next slide, I've just considered a few thoughts here on the different types of lenders, and not looking at some of these factors and some of these criteria, if you like, and the sort of pros and cons of the different, some of the different types of lenders out there. I'm not going to run through these in detail, just to sort of keep us moving along, but you can see them there, and these slides will be available afterwards. As an overarching point, though, and with any type of lender, for me, the relationship with that lender is absolutely critical. I know it perhaps is stating the obvious, but I'm going to do it anyway, and I have. And understanding where each of you are coming from in terms of what you want to get out of a particular deal, and trying to ensure that those interests are aligned as much as possible. We've had plenty of experience over the years of entering into a deal and discovering halfway through the transaction that actually what you thought the lender was doing, or what they thought the borrower was doing, doesn't quite match what is actually happening in reality, and you have to go back, unwind it, and start again. So it is important to be absolutely clear about what each side is hoping to get out of the arrangement at the very start. And then as a final note, I haven't talked about the different types of financing facility, but I'll just mention them very briefly. So you've got your traditional sort of forms of finance. You've got your overdraft, your term loan, your revolving credit facility. But as we've seen, I mean, if I describe some of these as innovative now, you may say, well, that was innovative 10 years ago, but it's not so innovative now. But invoice discounting is very much on the rise, which is all factoring, as is called differently, asset finance, and loan notes of a variety of types, which can be relatively easily adapted to suit the business needs. And I know we'll touch upon them a little bit later. So that's all had to say, I mean, I know as a quick blast through a lot of thoughts about raising debt, but at this point, I'd like to bring Matthew back in just to ask him if he's got any particular thoughts or experiences on the businesses that he's invested in or advised when it comes to raising debt.
Yeah, I mean, overall, I think debt's a bit underrated. People think if they've got to, especially some techie startups, they think if they want to get money, they've got to go through a whole funding round, and actually that might not be the most appropriate way of getting money in. It's certainly not that easy. So if there are, like you say, there are a lot of criteria to hit before you can get debt. But the wonderful thing about debt is there's a couple of good things. One is you don't have to give away any of your shares, so you don't have to give away your company. So if you do get a big exit further down the road, you get more for yourself. So that's good. And the other thing I often think of with debt is, especially recently, even before COVID, I think there was much more of a trend to companies being more sustainable rather than growth at all costs, which is really good. And then I think since COVID, even more so. But what debt also does, I sometimes think, is focuses the mind on being sustainable, on getting revenue, because you have to service that debt. You have to pay it off bit by bit. And sometimes with naive founders in the equity side of things, they raise the money and then it just kind of pushes the problem further down the road. But having the right kind of mix of debt in there can be good.
Great, thank you. And back to you, I think, Simon.
Thanks very much, Martin and Matthew. And I see that Jodie's dropped a line into the comments box. So thank you very much. We'll come back to that later because it very much ties into the equity if we move on to the next slide. And Jodie's asked around Matthew's thoughts on valuations. So as I say, we'll come back to that. Thank you. What I just wanted to recap on before we look at the fundability point around equity is just to remind ourselves what the building blocks are when thinking of a share round. What we've got on this slide, and I go into a bit more detail on the next two slides, which will just allow you to take away, is, if you like, the sort of four main types of funding that we're seeing on the equity side. There's the ordinary share capital, which is very common at the early stage level. It very much creates an alignment of interests. That could be between co-founders, where it's a sort of quasi partnership, or it's when you're bringing in private investors where they are treated pari passu in terms of capital return, dividend, i.e. income, and voting rights. In some instances, we're starting to see within private investors coming in the requirement for the shares to be preferred. So at least when they come in, their investment is protected insofar as it can be, so that they are paid out first. And as you move up the sort of funding cycle, you enhance that with cumulative redeemable preference shares. That's very common for institutional funders, so venture capital and private equity, where it's effectively an enhanced preference share. There may be a fixed interest amount that accrues, and then there's also a priority at the end that those shareholders have, both on the capital side and on that accrued income entitlement. You may also have a redemption attached to that, so that the investor can effectively give notice after 5 years that it wishes to redeem those shares, subject to the company having the profits to do so. What we are seeing more of, and we've touched on that given the future fund structure around convertible loans, is the existence of convertible loan notes, or if it's a private investor, the existence of advanced subscription agreements, which effectively do the same thing. It's to bring in cash, it's to bring in capital. They have more sort of debt-like characteristics, so there will be interest, there will be a repayment date, but there's the option to convert into equity. And as we've touched on in relation to the future fund, that is by reference to a discount to the subsequent valuation on a funding round. So if we just move through the next 2 slides, you'll see that I've just put in a bit more detail around that, and we can come back to that if we have time. So then turning to the next slide, what Martin and I are doing here is really just trying to identify the alignment between the investment community and those that you are looking to borrow or to raise capital from, and to identify how you align those interests to really sort of fine-tune your offering when it comes to creating that fundable business. So running through the, if you like, the sort of 5 classes that I see, it's the private investor, and as Matthew says, that's the business angel funding. That's where they come in at the early stage. It's a longer-term patient capital, and the leverage they've got, or the sort of de-risking insofar as they've got, is the availability of seed EIS and EIS tax reliefs. So that in some way de-risks the early stage nature of the investment. And so it does come in at emergence and pre-revenue stage for the business. And what those investors will do will focus on 3 things: actually understanding the business model, the product and the service, but also understanding more about you, the co-founders or the founder, and what it is that you can bring to the business and your development opportunities. It's then ensuring that there's significant, or sufficient rather, collaboration between the founders and the investors. And to take an example, in terms of the work that I've done recently for an entrepreneur, he is focusing in early stage companies. He wants EIS tax relief, but equally he wants to motivate the founders. So it's more carrots than stick, if you like. He takes board and observer rights to allow engagement, but he's not focusing on control. So there's no, if you like, sort of heavy schedules of reserved matters in the investment agreements that require his consent. He has a very sort of fixed number of consents that require investor approval by a majority rather than it sort of controlled by him. On to venture capital, and it's helpful just to sort of understand the structures of those funds. Those are either institutional backed funds, or there is a entrepreneur who has sold and are reinvesting their capital into the sector in which they are familiar with, and effectively creating a venture fund. Because they're reliant on institutional funding, they need to have a return on that investment, so they will focus on the financial and commercialization of the business. So it's got to be revenue earning, and it goes back to the point on preference shares, that they need to have a return on their equity before other investors. It may well be worth, if you have time, if you haven't already, looking at the BVCA shareholders agreement, investment agreements that is on the BVCA website, just so you can see the sorts of controls and financial provisions that they have in their investment agreements. On the private equity side, you're effectively sort of going up the waterfall here. The funders of those funds are family offices and institutions, and you'll see from reports in the press that private equity are active. They're actively looking for undervalued opportunities where they can take them and develop them and grow them for profit. They have a lot of capital at the moment, but they are looking at businesses with strong cash flow and growth opportunities. What they will bring in is some leverage, so that really where it works is for an exit, whether that's a sort of partial exit where you're rolling over but staying within the business to provide that next stage of expansion, or a full exit with a new management team coming in. So really we're in the sort of exitability stage rather than the fundability. The 2 other investors that I find particularly interesting are around the trade partnership, or the joint venture, and the family office, that are becoming more active in investing directly. On the trade side, what it creates really is a quicker opportunity to market. The way I see it is they're effectively sort of outsourcing their R&D, and you, the founder, or you, the management team of the business, are developing and focusing on the product or specific service that enhances or complements their particular offering in their specific sector. And really, it's not necessarily a funding round. It's almost issuing equity to the co-founders or the management team to incentivize them to focus on the commercialization of that specific service or product. So it's there to reward rather than fund, because you're then able to leverage off their support and already established infrastructure around services, HR, finance, without the need to have to go out to the market to raise and create all that operational side. For that, and again, you know, as founders, it's sort of focusing on where you want to get to in terms of exit. It's sort of one shot, because ultimately your exit will be a sale to them, or a sale by you and them of the underlying business. A couple of examples there. We acted for a inbound investor earlier in the year, where they have provided a convertible loan note. They provided debt via a convertible loan note to a pre-revenue technology business in the car battery technology sector. What they are doing is they are providing seed capital, and so there's a sort of financial focus there. But equally, they've got a cooperation and a collaboration agreement where they are able to share know-how, share technology. And then lastly, the family office. And they have very similar qualities, if you like, or interests to the private investor. It's around patient capital. And I think what's going to be really fascinating is for family businesses who may have limited liquidity and may have a real focus within their business on a particular sector, which could be, you know, real estate. They are looking to diversify. They may have learned over the last 6 months that actually the conversations they've been having with the next generation in the family, or the conversations they've been having around diversification is really come to the forefront. And so they will begin or are already investing directly into businesses that could be early stage or could be at the sort of venture capital, private equity level. And what I also think is a really interesting element is that they have a wider focus. It's not just financial returns, whether that's long-term or short-term. It's the ESG aspects. You know, what is it that the business they're investing in is doing from a wider society perspective? The impact on the environment. What's the governance like? And I've been listening to family business clients recently, and they are very much focusing on diversification and bringing their experience to businesses. How do you engage with them? Well, as a plug for a session we're running later on For Profit for Good, the really interesting element is the existence of B Corp certification. And it's something that I think that early stage and more advanced businesses should be looking at, because what that does is that it's effectively a sort of global kite mark, it's a global certification run by the B Corp movement that effectively assesses a business's wider contribution and wider sort of stakeholder capitalism. And I think it's something that any business that's looking to attract investment should be considering. I'd just like to move on to the next slide as we move towards our concluding session, part of our session, is really trying to think about the action to take. What is it that you need to be doing in terms of getting to know your investors? We've spoken about the alignment, and it's trying to emphasize that. And then it's being flexible and trying if we can in these current circumstances to think ahead. And what I mean by that is knowing your investors takes time. Don't underestimate, it's not just a one-way direction of travel on due diligence. You've got to know them and they've got to know you, get to know you. And that's come out of Martin's observations on lending. Equally, it applies on the equity side because, as Matthew says, you're giving away equity, you're giving away control. So you've got to know those individuals. I think you will have seen over the course of Martin's observations and my observations that it's all about alignment. It is a relationship. It's a collaboration with control, a significant part of that. And what that means is you've got to think ahead, because in turn that develops the commercial and legal infrastructure of any fundraising. It's being familiar with the investor and what sort of rights and controls they want. It's thinking about how you grow and protect your revenue. So from a legal perspective, focusing on customer contracts, terms of business, cash management. And then and this is the key bit, this is about how you protect and develop the talent, because ultimately when we listen to investors, yes, they're looking at the idea, but also they're looking at the individuals behind the business. So how do you retain, how do you reward your founders and your wider management team? And previously in the week, we've had sessions on share option schemes. We've had sessions from our unemployment team on rewarding your employees and protecting your employees as well. So if we move on to the next slide, we just wanted to reflect on our observations and bring it back to that fundability point. Please do share your thoughts through the chat link, because we really want to spend some time just answering questions, sharing our thoughts. And Matthew, if I can hand over to you, because I know there's a specific question that you've got. Hopefully you've had a chance to think about that. Thank you.
Yeah, sure. Yeah, no, there's lots to think about there. I think particularly, Jodie, on valuations. So we've had, I don't know, it's been a bit of a roller coaster, as it has for everybody. In March and early April, I was just inundated with people looking for money. So I think a lot of investment had dried up, and that just felt like a deluge of people, wanting to plug gaps in their investment round. But as Simon's saying, take time with your investors. We take loads of time with investment opportunities. In fact, if I meet someone right now and they are raising money when I meet them, then it's an automatic no for this round. That's how kind of slow we are. Often, so we may invest in the next round if we like each other, but it's certainly not as quick as others. On valuations, so 3 of our portfolio have raised funding in lockdown. The valuations were all up significantly from their last valuation, but it's probably fair to say that they were lower than they would have been without COVID. So we've not seen down rounds, but we've certainly seen a kind of probably a dip in the trajectory that their valuation would have been on. But that's fine. I mean, I'm not going to get too upset about that as long as it's going in the right direction. We invested in 2 of those 3 companies that raised, so it's fine. Investors can often have got a better deal, and the valuation we're most interested in is the ultimate exit. So if it kind of, as long as it goes in the right direction, if there's a little kinks along the way, that's okay. Nothing to lose sleep about.
Has that sort of pushed out timelines and horizons when it comes to bringing in investment? Have businesses been more cautious in what they include in their business planning, what projections and provisions they're making?
Yeah,
because of the sort of fluid situation we're in.
Yeah, definitely. Like I said earlier, there's much more of a push for sustainability. I mean, it's a bit of a running joke, but often startups say we're going to get this funding round and then we'll never have to raise again. They always say that. But I think more and more it is in their minds much more to focus on sustainability, and because if they ever do need funding, actually that will make them more attractive. So it's a great thing.
And Martin, any thoughts there from the lender's perspective as to the detail that they are putting on the future sort of business planning and well, numbers really that businesses are giving to them when they're looking at lending?
Yeah, it's interesting. It's difficult because at the same time as you're looking to forecast and be as certain as possible around, everybody likes as much certainty as possible. We are in possibly one of the most uncertain times that we've had for, I don't know, ever. So it's very difficult to sort of when you're sort of casting forward the forecast. So I know I said in my session when I spoke about detailed forecasts based on credible assumptions. Now, that is absolutely true, but there is only so far you go. And I think actually lenders are sort of relatively realistic about this. From talking to a number of lenders and actually from talking to borrowers, I think they have found that lenders have been relatively pragmatic about this. So when it comes to sort of looking forward about setting it, you often see it come to the fore when it looks to set financial covenants. So you're looking at how are you going to sort of set the expected financial performance of a company over the period of the loan, and where are the minimums you want it to be. We've certainly seen in the short term, those have been waived or relaxed to some degree. But actually, if you're looking to agree something now, we've had plenty of conversations with lenders about when can we realistically start those financial covenants coming in and sort of starting to bite in the ordinary way they would always do. And we're looking, 12, 18 months ahead, I think. Sort of yes and no. Everyone wants to sort of certainty and to be able to forecast as accurately as possible, but there is a pragmatism and a realistic approach here that it's really very difficult right now.
And is that reflected in terms of the practicalities on the ground with the banks? I'm just seeing in terms of on the chat, Ashley and Matthew's responded is, how do you get that connection into the right investor? I mean, equally that applies to how do you get that connection into the right lender? I was going to say, are there some you should avoid or not? But we don't want to go down that route. But it must be very much like looking at your investor. You've got to get the right fit with the team at the bank or the
yeah, absolutely. And I'm sure that the people listening, I mean, most people will start with their existing lenders or existing bankers and hope that they will be able to help them. It's been at the start of the lockdown, you had people trying to access the government lending schemes one way or another, and the banks were inundated with requests, and so they had to prioritize. And typically they prioritized existing customers, and which is understandable, of course. But now we've sort of moved through, and and who knows quite where the next 6 months will take us. But now we've moved through, and you're looking at which lenders to sort of strike up a relationship with. It's quite difficult to test to guess at what any lender's appetite might be. Some lenders I know have said they're not open to new to bank business anymore, or for the time being, because, well, it's either because they're prioritizing their existing customers or because they simply don't have the capacity to deal with the number of requests out there, and they're having to try and limit them as much as possible. I was hoping that that might start to ease now, and we're very much waiting to see whether that is going to ease. But you're right. To the extent you can, I mentioned that the relationship with the lender is key. That's still true. It's just a little bit harder to find one at the moment.
You mentioned the fact that banks or funders are open to covenant postponement and extending that beyond the sort of next 3 to 6 months. Is it? Are there any sort of observations you make about sort of keeping in touch with your lender and sort of informally rather than just purely sort of formally? Is there a benefit to be had there?
Yeah, no, well, absolutely. I think the closer you are to their radar, the better. I mean, when giving webinars at the start of this, I think we sort of laboured on the fact that communication was absolutely key. You may not know exactly what is going on right now. You know, nobody knows exactly what the economy is going to do. No one knows exactly what your business is going to do. But if you keep those communication lines open, it's the same. Is true, I'm sure, of investors. When you keeping communication lines open is absolutely critical.
Matthew, can I turn to you on that? And sort of from an investor perspective, what works well for you when it comes to engagement?
Little and often, really, is the key.
Like my diet.
Yeah, exactly. You know, we typically, you know, I've got a syndicate of over 70 investors who angel invest with me and my business partner, who was on a session earlier in the week, and we just try to talk to them as much as we can. You know, we don't want to bother and we don't want to meddle with them or anything, but where there are things to say, then we you know, try to keep it short. Typically, our one-to-one conversations are on WhatsApp, so we just ping them a WhatsApp message. You know, no one wants more email these days, I don't think. And we also have a Slack channel for all of the syndicate members if it's a one-to-many type communication. And then from a portfolio point of view, you know, it always seems to worry investors when the companies are quiet, when you don't hear from them. That's never a good sign. You know, if you're used to getting monthly updates and then you don't hear from them for a couple of months, the hope is that they are super busy, but the reality is that's probably not true. So, you know, short, frequent communications can solve an awful lot of problems.
I would like to just pick up your points around sustainability, and we can be, and it's human nature to be very focused on the short term, and particularly sort of, you know, reading and hearing from the media. Just to play it forward in terms of, you know, 2019, 2020, 2021, do you think there'll be a sort of different approach to fundraising? Have you had any thoughts as an investor as to, you know, how things may change as a result of the last 6 months?
Oh goodness, I mean, it's still quite early. You know, I think we're in this for a long time. I mean, some things have surprised me in terms of the funding, like 3 of our portfolio companies raising, one raised 2.3, one raised 2.5, and one raised 2 plus about 2 from the Future Fund. I mean, I was quite surprised at that. That was fantastic. A 4th portfolio company, their business has gone up 5 times because of as a direct result of lockdown and such like. So that's been quite surprising. But we're still early. In terms of appetite from the syndicate members, it's still there. You know, for some people, they seem to, you know, instead of wanting, I don't know, these aren't the right numbers, but imagine a syndicate member has £100,000 and they want to invest in 5 startups. Well, they still want to invest in 5 startups, but maybe they'll invest, you know, 50 or 60K instead. So the desire to invest in the same number of companies is the same, but then perhaps the amount in each is slightly lower. But then I've been surprised the other way as well. You know, a couple of syndicate members I got in the funding round that we're just finishing off. I got bigger checks from them than I thought I would.
And the businesses, is that to effectively reinforce their sort of cash position? So they are going perhaps slightly bigger on their fundraising to just kind of insulate them as much as they can. Is that rather than
2 of the 3? Yes, definitely.
Yeah.
You know, one in particular is a healthcare company, health tech company. So it was a case of, okay, you know, now's the time, let's crack on.
Yeah.
And they did a month of Zoom calls with dozens and dozens of investors, including, family offices and private individuals and VC funds, as you had on previous slides. And yeah, they got it done, and it was marvelous. Great, good on them. And that was very much to, get some solid cash in the bank, and then go on a big sales push.
Yes, and it's very sort of sector dependent and business dependent, because that is for expansion rather than just sort of, if you like, survival.
Yeah, absolutely. I wouldn't want to invest in a coffee shop right now. I think all this save Pret stuff is nonsense. That world's gone. Let's look at the future.
Yeah. And I guess, just as a sort of further follow-up, have you seen businesses rewrite their business plans to adjust to the circumstances, realizing the limits of where they thought they were going to go and sort of their distribution channels, but able to sort of, if you like, pivot to, okay, well, here's the opportunity. We're not going to be scared by this. We've got the confidence to sort of change and kick on, and here's our pitch.
Yeah, absolutely. If they haven't changed, then something's wrong, because the world has changed. And it's, there's different sort of levers they can pull. At the beginning of lockdown, it was a case of, they're probably going to get rid of their office, work remotely. That can save, those sorts of things can save an awful lot of money. But then if they get this investment in, then they have to, that sort of allocation of capital is really, really important. You can't just keep doing the same old things and expect the same results. So they had to very much refocus on the metrics that they were looking at, and what they were, what growth did mean, what sustainability did mean, and what are the sort of one or two fundamentals that will drive that. And that's quite different to what they would have been doing last year. And that's helped with the fundraise.
And Martin, can I come to you? Does that sustainability factor get acknowledged in the lending? So perhaps traditionally you were having sort of 3-year, 5-year term loans. Will the banks or funders recognise that there are sort of far longer repayment periods?
I think, in my experience, it's fairly difficult to get more than a 3 to 5 year term. I mean, actually, even 5 years is kind of pushing it. I fully appreciate all of what we've been talking about, and the need to think longer term, and the need to sort of place yourself on a stabler footing for as long as possible. But does that mean that a lender will commit funding for that period of time? Perhaps not. What I think they would say is, I'm going to come back and say what I said before, which is again about the relationship, because you got, keeping your lender on side and supportive is down to communication, and if your financing term is coming to an end, then talking to them early, or asking about extending it is important, and that layer of communication, and ultimately it will come down to the relationship you have with your lender as to whether you can then roll it forward. Obviously there are many other factors in that decision, but ultimately you've got to put yourself in as best place you can to do it. But does that mean a lender will commit for that longer period of time right at the outset, especially now? Probably not.
Yeah. And there are alternatives out there, aren't they, that are able to provide longer term debt.
Yeah, again, then we sort of drift slightly more towards your world, which is, so you sort of move away from the traditional debt providers towards the people that would provide a mixture of, debt and equity, whether it's some sort of loan note program. Then you can sort of push the term out, because it's an entirely different approach. If you're looking at it from a traditional lender perspective, they will have a traditional way of looking at it, I would say. And they want to ensure that, serviceability and repayability within the given term is important. But you move to someone that's more sort of aligned on the investor side, and actually then you can start to sort of, as we've talked about, blending the debt and the equity in order to create the sort of capital structure that you want that will provide that sustainability for the longer term.
And I suppose that then starts displaying sort of mezzanine type characteristics, which probably isn't quite on point for this session, but to say that there may well be funds out there that sort of try and bridge that gap.
And absolutely they are. I mean, again, the cost, it comes again, you look at those criteria, they may take a sort of step back in terms of control. They may be able to execute quite quickly, but in terms of the cost, it may cost a bit more. But again, when you're comparing it to the cost of giving away shares, having a 10% coupon rolling up for a number of years, yes, it's expensive, but if your business does well, it's not as expensive as giving away equity.
Martin, thank you. I'm conscious that we are coming up to 12:30, so I just wondered if I could just invite Matthew for any sort of final observations in terms of what makes a successful fundraising, maybe just one or 2 points, and Martin, perhaps the same as well, just as a sort of final recap.
Sure. I mean, take your time. There's some chat about how to find the right investors. It's annoying, right? Because I would like to find, the right unicorn this afternoon as well, but that's not going to happen. So, take your time, make sure there is alignment. It's all about having alignment, because things are going to get difficult. Running a company is extremely difficult, extremely challenging. You're going to want to give up. You're going to be under pressure to give up, especially if you start up doing something new. So be patient and think about what you can do now for building that network before you really need it, so that you can call upon that advice and the money and everything else later down the line.
And to add, to add to that, I would say it's supplementing it rather than it's not an entirely different point, but it's something that we've mentioned a lot about the sort of the relationship with your lender and ensuring that the interests are aligned and understanding where each of you are coming from and what each of you wants to get out of the deal. As I said, we've seen plenty of situations where you thought that was the case, but actually the more and more you get into the deal, it turns out not to be. So communication and really understanding the lender that you are about to borrow money from is absolutely crucial. And then, so picking up on Matthew's point about taking the time to make sure you do actually understand those things is time very well spent.
Thank you. And I think, just from my perspective, just to sort of wrap up, this is the time to think creatively, as to whether the sort of traditional sort of debt, equity, mix of equity, combination, combined, conversion, are the right things to do. There's a moment to reflect as to whether you can offer other things, whether you can collaborate with others to take the cost off the bottom line, and find other ways to grow your business that we haven't thought about up until now. So I think that would be my sort of parting observation, that there is time to think. There's time to, as Matthew says, talk to your advisors, talk to your investors, and see what routes there are to growing your business. We are going to put ourselves sort of off screen and on mute to stay on for another 10 minutes and just answer some of the chat that's coming through online, and particular thanks to Monica there and Tim. Please do send through any questions or comments, and we can keep the conversation going. But I would just like to say many thanks to Matthew for joining us. Martin, many thanks as well. And many thanks to all of you for taking the time out of your day to log in. I hope I'll see some of you on screen with your cocktail mixer in hand tomorrow evening. But thank you very much.